We're going to be expecting an anchor point to form on a Monday, Tuesday, or Wednesday, and we're utilizing external range liquidity pools to facilitate an entry in the direction of the weekly expansion and exiting on opposing external range liquidity pools. So we're selling external range liquidity. Okay, what do I mean by that? Outside of the range of this low to high, this is where the most present dealing range was prior to this movement above. Yes, there's a range here to here. Okay, I'm not arguing that. The idea is the range is this low and this high. We want to see price run above that. Why? Well, it has a liquidity void in here, and price has got to go trading up into what? A premium. It has to trade above an old high, and it has to trade into a premium. We want to be selling short up there. Now, we have an old low. We know trading below that, that would be an external range liquidity target. If it's not 50 or 75 pips or within that range of 50 to 75 pips, you would hold for lower prices. Because again, the weekly chart's suggesting lower prices, so it's probably not going to stop just here. It's going to want to look for some discount array. So to get to a discount array, what's the parent price swing that it's retracing inside of? This high to this low. Midpoint roughly is here, so it has to go below this price point here to get down to equilibrium and or to a discount. This low is formed below equilibrium of this parent price swing here to here. So when this low forms and price trades down below that, that's a perfect opportunity to collapse the trade. You're looking for external range or turtle soup shorts to go short, and then turtle soup longs to cover. It's as simple as that. Now, partials. Once we trade below this low here, take a partial off. Price trades down lower, creates a short-term low, it spikes up, it trades below it here, you take a portion of it off. Price comes down, creates another short-term low, it rallies up. You know if it trades below this low here, we're in a discount, take your final portion off there. Okay? If you were so inclined to take a long in here and using this turtle soup as an entry going long, as price creates this short-term high here, you can take partials out right there. Price runs up, creates a short-term high. When price runs above it on this candle, you take a partial here. Look over here, you have this old high here. If price trades above that high here, you collapse it. If you take two partials, you want to really be protecting the open position at that point, because after two partials, generally, that's kind of, just think like three drives pattern, where it creates a high, a higher high, and a higher high, and then a rejection occurs, and it has like typically an intermediate term high forms. Well, you can see that almost forming here. You have a short-term high, a short-term high, and a short-term high. It runs through that, and it creates little tiny ones in here, but until it presses above this high, all these are insignificant in my mind. But once we get above this high, this short-term high, then this short-term high, and this little spike here, all of this, I would have not been in. I would have been just out right above this high here on this candle and been done with it. So, two partials on the third, take profit, all your position comes off. So, from a visual standpoint, over here, this is what you're looking at. You want to see an area where there is a single high or double high. Either one of these scenarios will work when you're bearish. When price runs above that, and it's during a kill zone, and it's day of the week that will promote a continuation down. In other words, ideally on Monday, Tuesday, or Wednesday when it's a weekly bearish scenario. That's ideal. And then trading down into an old low, or it could be a double bottom that it runs stops on. And we're practicing and studying when price does that very thing. What we're looking for, we want to see price trade above the opening price. Here's Wednesday, it does that. It does so in the form of running above an old high. In an environment where we're already bearish, expecting lower prices, so we can see we're running above an equal high back here. So look at it like this. run above, you want to sell short there. Price breaks down. Once price takes out this short-term low here, you can take a partial there. Market trades down, creates a short-term low here, starts to run up. If price takes out this low, we can take another partial. Or it could be your first partial, because you would anticipate maybe this low being your second. Old lows to the left take precedence over new short-term low, because you have an old low back here. The liquidity is resting below here. This is a big pocket of liquidity. Why? Because we have movement away from it. It hasn't been back to this price point in a while. So this short-term low here, after seeing a run above this and coming back down, you want to try to hold something on to get below that low, and we get it here. Look how much energy it takes to trade down into that. Hits it here, small little retracement, sells off again, optimal trade entry, sells off one more time, and hits the objective pretty much almost to the pip. Okay, and you'll see that this model is everywhere. And it gives you a wonderful framework for trading outside the core liquidity that's seen with a range-bound market. Like this would be a range high, and this would be a range low. Trading outside of the range and outside of the range, and using those as your entry and exit point, that's the apex of predatory trading. Getting in at sell stops and getting out at buy stops. You're using counterparty liquidity theory for your entire model.